Today, we're doing a complete breakdown of AASB 116. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying AASB, prepping for a Big Four interview, or working in finance, this is everything you need to know. Asset valuation was a mess before AASB 116. Imagine companies valuing identical machinery differently, leading to balance sheet confusion. AASB 116 brought order, mandating consistent treatment of property, plant, and equipment. With this section, you'll understand how it standardized asset reporting, ensuring clarity and comparability across financial statements. AASB 116 was created to tackle the inconsistencies in how companies reported property, plant, and equipment. Prior to this, companies could choose various methods to value assets, leading to confusion. AASB 116 requires companies to capitalize costs, making financial statements more comparable. This standard ensures that assets are recognized and measured consistently, impacting net income and balance sheet presentation. Effective from 1 January 2005, AASB 116 is a must-follow for all entities reporting under AASB. It primarily targets public companies with large asset bases. The key requirement is straightforward. Capitalize the costs of property, plant, and equipment, then depreciate over its useful life. This ensures accurate asset valuation, crucial for investor trust and financial transparency. Under AASB 116, companies choose between the cost and revaluation models for asset reporting. The cost model maintains assets at their initial cost, adjusting for depreciation. The revaluation model, however, reflects fair value changes, impacting equity and comprehensive income. Consistency is key. Companies must apply their chosen model uniformly within each asset class. Understanding these models is critical for interviews, as it reflects how a company's asset valuation affects financial statements and investor perceptions. Misunderstanding the scope of AASB 16 is a frequent pitfall. Many candidates mistakenly think investment properties fall under this standard. They don't. AASB 140 covers those. Knowing precise inclusions and exclusions in standards like AASB 116 is crucial for accurate financial reporting and avoiding costly omissions. AASB 116 governs tangible assets like machinery used in manufacturing or buildings for administration. Finance leases also fall under its scope. Understanding what types of assets this standard applies to is essential, especially when dealing with large capital-intensive industries where these can significantly impact financial statements. Investment properties might seem like they belong under AASB 16, but they're actually covered by AASB 140. Similarly, biological assets are under AASB 141, and intangible assets like goodwill are addressed by AASB 138. Knowing these exclusions helps avoid misclassification, which can lead to misreported financial outcomes. An asset, as per AASB 116, is a resource expected to yield future economic benefits. Consider a factory purchased by a company. The factory is an asset because it will help produce goods generating revenue. Control is key here, as it means the company can decide how to use this factory for its benefit. Depreciation under AASB 116 involves allocating an asset's cost over its useful life. Imagine an office desk bought for $1,000 with a useful life of 5 years. Each year, $200 is expensed as depreciation, aligning with the revenue the desk helps generate. This systematic allocation ensures expenses reflect asset usage accurately. Navigating AASB 116 can be tricky with edge cases. Leased machinery in a finance lease is included, but not operating leases. Patents fall under AASB 138. Agricultural assets like crops relate to AASB 141. These nuances often trip up candidates, so mastering them can set you apart in interviews. Companies frequently struggle with accurately reporting the value of their long-term assets. AASB 116 introduces the cost and revaluation models, providing a structured approach to asset valuation. Imagine a company with diverse assets needing clarity on how to report them accurately. This model guides them in aligning asset values with current economic realities, ensuring transparency and consistency. The cost and revaluation models under AASB 116 help businesses like Meridian Corporation manage asset valuation effectively. With a $10 million SaaS contract involving an $8 million software license and $2 million in services, these models offer a roadmap. By meticulously applying each step of this model, companies can ensure their balance sheets accurately reflect asset realities, aiding better financial decision-making and ensuring compliance with accounting standards. The journey starts with determining the initial cost of an asset. For Meridian Corporation's $10 million SaaS contract, this involves allocating $8 million to the software license and $2 million to implementation services. This step ensures all directly attributable costs are captured, avoiding undervaluation. Many miss including all necessary costs, leading to inaccuracies. By capturing every directly attributable cost, companies set a solid foundation for precise asset valuation, crucial for subsequent steps. With the initial cost of Meridian Corporation's SaaS contract determined, the next decision is choosing the appropriate model. Given the defined nature of the $8 million software and $2 million services, the cost model is a suitable choice, reflecting stable asset values. Many err by selecting a model misaligned with asset characteristics. AASB emphasizes choosing a model that mirrors the asset's economic reality, ensuring more accurate reflection on the books. Meridian Corporation, having chosen the cost model, must now measure the value of its SaaS contract. This involved recording the asset at its original $10 million cost. Errors often arise from miscalculating initial costs, impacting asset valuation. AASB mandates that companies like Meridian accurately reflect the asset's cost, ensuring transparency and reliability in financial reporting. This step sets the stage for appropriate depreciation, reflecting wear and tear over time. With Meridian Corporation's SaaS contract valued at $10 million, the next step involves applying systematic depreciation. This requires spreading the cost over the asset's useful life, ensuring the financial statements reflect asset usage accurately. Many companies struggle with estimating useful life or using inconsistent rates, leading to distorted expenses. AASB emphasizes that depreciation should mirror the consumption of economic benefits, ensuring financial accuracy and integrity. The final step for Meridian Corporation involves recognizing any impairment losses. If the value of its SaaS contract falls below the recorded carrying amount, an impairment must be recognized. A frequent error is neglecting regular impairment assessments, which can lead to overstated assets. AASB requires consistent testing to ensure that asset values accurately reflect their recoverable amount, maintaining the integrity of financial statements and supporting informed decision-making. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. For property, plant, and equipment, AASB 116 gives options like cost or revaluation. But the real kicker? Certain disclosures are mandatory to provide a complete picture for stakeholders. Let's see how this plays out. Assets are recognized when future economic benefits seem probable, and costs can be measured reliably. Initial measurement happens at cost, factoring in the purchase price and directly attributable costs like installation. Recognition kicks in on the date control transfers, not just when you decide to purchase. For assets under $5,000, you can expense them directly, easing the burden of tracking minor items. Post-initial recognition, AASB 116 lets you choose between cost and revaluation models. Cost keeps assets at historical cost minus depreciation and impairment. Revaluation ensures that the carrying amount mirrors fair value. Regular revaluations are crucial to avoid material discrepancies. Depreciation tracks asset consumption over time, affecting the profit and loss. Altering depreciation methods or useful life? Handle those changes prospectively, shifting only future financials, not past records. PPE takes its spot on the balance sheet as a non-current asset, with accumulated depreciation shown separately. Depreciation? It's an expense on the income statement, trimming down operating profit. Valuation methods and depreciation rates find a home in the notes, along with any asset reclassification. Land and buildings? They get distinct classification, boosting transparency for stakeholders trying to decipher financial health. Depreciation methods and assumptions need disclosure for clarity. If using the revaluation model, describing its frequency and method aids fair value assessment. A reconciliation of carrying amounts at the start and end of periods is essential, providing a transparent view of asset evolution. Impairment losses and reversals, they tell a story about asset recoverability, crucial for economic outlook analysis. These disclosures paint a complete financial picture. Picture a CFO managing a $1 million machinery acquisition. Opting for the cost model, depreciation clocks in at 10%, cutting $100,000 from profits annually. Though the revaluation model was on the table, it seemed too volatile. An impairment test later reveals a $50,000 write-down, altering asset value and tilting profit margins. This scenario underscores the nuanced decisions behind AASB 116, shaping financial landscapes one choice at a time. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. See how the lease appears on the balance sheet under AASB 116, transforming operating leases into visible liabilities. It's a game changer for financial transparency. When Meridian Corporation signs the lease, AASB 116 requires it to recognize a right-of-use asset and a lease liability. The asset represents the benefits of using the warehouse, while the liability mirrors the obligation to make lease payments. This significant shift ensures that leases are no longer hidden off the balance sheet, enhancing transparency. Making the first lease payment reduces the lease liability, demonstrating the company's commitment to its contractual obligations. AASB 116 requires this payment to be recorded against the liability. This transaction also decreases the company's cash position, providing a real-time glimpse into liquidity management and financial health. Depreciating the right-of-use asset aligns with AASB 116 principles, spreading the cost evenly over its useful life. This monthly charge of $20,000 reduces the asset's carrying amount, showing the gradual wear and tear. As assets depreciate, they impact the profit and loss statement, crucial for stakeholders assessing asset utility. The interest expense is a pivotal element of lease accounting under AASB 116. This $5,000 charge reveals the cost of leasing as a financing activity, impacting the profit and loss statement. Monitoring this aligns with real financial burdens, ensuring the balance sheet reflects the actual cost of using leased assets. Quarter-end adjustments are crucial for accuracy, ensuring all accrued expenses are accounted for. AASB 116 mandates this to reflect ongoing lease costs. $15,000 in interest and $60,000 in depreciation align the ledger with actual expenses, providing stakeholders with clear insights into operational efficiency and financial obligations. This end-of-period lease payment keeps liability in check and reflects Meridian Corporation's disciplined financial practices. Recording it under AASB 116 ensures transparency and accuracy. By reducing the lease liability by $240,000, Meridian maintains a balance between obligations and cash flow, vital for sustaining financial health and investor confidence. De-recognizing the fully depreciated asset and liability marks the lease's culmination. Under AASB 116, this entry finalizes the cycle, showing that Meridian Corporation has met its lease obligations. Removing $960,000 from both accounts cleans up the balance sheet, enhancing clarity and presenting a true picture of financial health post-lease. Every Big Four and investment bank interview on AASB 116 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. AASB 116 governs accounting for property, plant, and equipment. It ensures consistent asset recognition on the balance sheet. AASB 116 allows companies to choose between cost and revaluation models. A common error is confusing these models. Remember, AASB 116 is about recognizing, depreciating, and de-recognizing fixed assets. It's crucial to differentiate asset costs from repair costs. AASB 116 exists to standardize reporting of property, plant, and equipment, ensuring comparability and transparency. By regulating asset capitalization, depreciation, and impairment, investors get clear insights into a company's asset management. A common mistake is overlooking impairment indicators, which skews asset valuation. Mastering AASB 116 means knowing how it impacts financial statements and investor decisions. A revaluation increase is credited to revaluation surplus in equity, unless reversing a previous decrease recorded in the income statement. The key point is understanding this distinction, as misclassifying it affects equity and profit. An example is revaluing an asset from $100,000 to $120,000, crediting a $20,000 surplus. Remember, revaluation impacts both equity and financial ratios. Residual value reduces the depreciable amount of an asset, directly affecting depreciation expense. For example, a machine costing $50,000 with a $5,000 residual value depreciates based on $45,000. Ignoring residual value inflates depreciation expenses, skewing profit margins. Always factor in expected residual values to accurately calculate depreciation and reflect true asset consumption. The primary difference between Indian Accounting Standard and International Financial Reporting Standards in AASB 116 is the frequency of revaluations. Indian Accounting Standard mandates annual revaluation, whereas International Financial Reporting Standards allows discretion. This affects asset values and depreciation rates. Confusing these can lead to misreporting. Always align asset valuation practices with the mandated standard to maintain compliance and accuracy. No, intangible assets are not covered under AASB 116. They fall under AASB 138. Confusion here is common but crucial to avoid. AASB 116 focuses on tangible assets like machinery and buildings. Knowing asset classification is vital, as it dictates different accounting treatments. Memorize asset boundaries to prevent misclassifications and ensure compliance. Upon selling an asset, debit cash and accumulated depreciation, credit the asset account, and recognize gain or loss in the income statement. For a $10,000 asset sold at $8,000 with $3,000 depreciation, debit cash $8,000, accumulated depreciation $3,000, credit asset $10,000, record $1,000 loss. Precision here affects profit figures. Recognition involves initial asset recording at cost, including purchase price and incidental costs. Derecognition occurs when an asset is disposed of or no future economic benefits are expected, removing it from the balance sheet. Misunderstanding these can lead to incorrect asset valuation. Always know when to update financial records accurately. AASB 116 disclosures include asset measurement bases, depreciation methods, useful lives, gross carrying amount, and reconciliation of carrying amount at start and end of period. A trap is omitting reconciliation details, which clouds asset movement transparency. Accurate disclosures ensure stakeholders understand asset management. Remember, clarity in disclosures prevents misinterpretation. Understanding the basics of AASB 116 is essential for handling property, plant, and equipment. These assets must be recognized when they bring future economic benefits and are measurable. AASB 116 covers all PPE unless stated otherwise by another standard. Initial measurement starts at cost, considering directly attributable expenses, with significant components requiring separate depreciation treatment. Grasping these fundamentals ensures compliance and accurate financial reporting. AASB 116 offers two models, cost and revaluation. The cost model maintains assets at cost minus depreciation and impairment. In contrast, the revaluation model reflects fair value minus depreciation, allowing periodic asset value updates. Revaluation surpluses appear in other comprehensive income, not profit. Regular review of useful life and impairment ensures assets reflect their true economic value and avoid overstatement in financial reports. When interviewing on AASB 116, highlight knowledge of potential pitfalls like incorrect depreciation methods. While AASB and International Financial Reporting Standards align closely, understanding those nuances matters. Disclosures must detail depreciation methods and revaluation events. Fair value updates should mirror market trends, and reviewing residual values keeps estimates accurate. Recognize when to de-recognize an asset to ensure financial statements reflect only those assets providing future economic benefits. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to CandiMentor for more accounting and finance videos.